Hey everyone, and welcome back. For those of you fascinated by mysteries, today's deep dive is going to be right up your alley. We're diving into the world of America's gold reserves. Don't forget to hit that like button, subscribe to our channel. All right, so the U.S. claims to have over 8,000 tons of gold, a hoard worth hundreds of billions of dollars at current market prices. It's a treasure trove that would make King Midas blush, but here's the catch. No one outside the government has seen this gold in decades. It's a modern-day riddle wrapped in enigma and seasoned with a dash of conspiracy. Is the gold really there? Has it been secretly loaned out, swapped, or even replaced with fake bars? Why doesn't the government just open the vaults and put all the rumors to rest? Buckle up as we unpack the fascinating history of America's gold reserves and explore the theories, evidence, and unanswered questions surrounding this hidden treasure. To understand the mystery, we need to go back in time to 1933, during the Great Depression. President Franklin D. Roosevelt, in a bold move to stabilize the economy, took the U.S. off the gold standard. He signed Executive Order 6102, which essentially made it illegal for private citizens to hold large amounts of gold. Americans were required to surrender their gold coins and bullion in exchange for paper dollars. This controversial action resulted in a massive influx of gold into the U.S. Treasury. And you can't just leave mountains of gold lying around, right? Enter Fort Knox, a military installation in Kentucky built in 1936 specifically to house this growing golden hoard. By 1937, tradeloads of gold, both seized and surrendered, were being transported into Fort Knox's heavily guarded vaults. As World War II loomed, the U.S. became a safe haven for gold from other nations seeking to protect their assets. By 1941, U.S. gold reserves reached their peak, with Fort Knox alone holding over 20,000 tons. Imagine that, enough gold to fill an Olympic-sized swimming pool. The U.S. held about two-thirds of the world's official gold, a concentration of wealth unlike anything the world had ever seen. This dominance stemmed from decades of trade surpluses and the influx of gold entrusted to the U.S. by European nations during the war. Gold became the bedrock of the global monetary system. Under the 1944 Bretton Woods Agreement, the U.S. dollar was directly linked to gold at a fixed rate of $35 per ounce. Other countries pegged their currencies to the dollar, with America's vast gold reserves acting as a guarantee. It was like the dollar had a golden halo radiating trust and stability throughout the world. But as with all good things, this golden age couldn't last forever. The post-war decade saw a shift in the global economic landscape. The U.S. started running trade deficits and shouldering substantial financial commitments abroad. Dollars flowed out to aid and support other nations, leading to a growing demand for the redemption of these dollars for gold as permitted under the Bretton Woods Agreement. Bit by bit, gold flowed out of U.S. vaults to satisfy these claims, steadily eroding the once impregnable stockpile. Fast forward to 1971, and the situation had become untenable. U.S. gold reserves had dwindled significantly, and the pressure to maintain the dollar's gold convertibility was mounting. President Richard Nixon, in a move that sent shockwaves through the world, took the U.S. off the gold standard. He closed the gold window, ending the dollar's convertibility to gold. This bold action shattered the Bretton Woods Agreement and ushered in a new era of fiat currency money backed by government decree rather than a tangible commodity. From this point onwards, the U.S. held on to its remaining gold, no longer allowing foreign entities to redeem their dollars for the precious metal. Now, if the dollar was no longer tied to gold, you might wonder why the Federal Reserve, the nation's central bank, still claims to possess such a vast quantity. Well, the truth is the Federal Reserve doesn't directly own any of the country's gold. All federal gold holdings were transferred to the Treasury Department back in 1934. However, the Fed retains a claim on this gold through a special document called a gold certificate issued by the Treasury. Picture it as a giant IOU for all the gold held by the government. This certificate, representing a nation's entire official gold stock, sits on the Fed's balance sheet as an asset. But here's where it gets interesting. The gold is valued at a fixed price of $42.22 per ounce, a price set way back in the 1970s. It's a fraction of what gold actually trades for in today's market. So while the U.S. dollar might not be directly backed by gold anymore, these reserves still play a symbolic role. They're like a security blanket for the dollar, a reminder of a time when money was directly linked to something tangible and precious. And the sheer size of these holdings sparks some intriguing possibilities. Think about it. If the U.S. government decided to revalue its gold reserves to reflect current market prices, the Treasury could potentially issue more of those gold certificates to the Fed. This would essentially create a massive injection of dollars into the system. They could use these funds to pay down the national debt or stimulate the economy. But despite these potential benefits, the government has consistently resisted calls to adjust the official valuation of its gold. This reluctance fuels speculation and raises questions about the true nature and extent of these holdings. Despite official pronouncements that the gold is safe and sound, a veil of secrecy hangs over Fort Knox and other depositories where this treasure is supposedly stored. Access is strictly limited, feeding suspicion and giving rise to a multitude of conspiracy theories. Some believe the gold was secretly removed or loaned out during the turbulent 1960s and 1970s, leaving Fort Knox as an empty shell, a facade of financial security. Others propose the gold actually belongs to foreign nations, deposited in the U.S. for safekeeping during times of global turmoil, a hidden legacy of wartime alliances and Cold War tensions. Adding fuel to the fire are concerns about counterfeit gold bars made of tungsten, a metal with a density almost identical to gold. These alleged fake bars could pass superficial weight tests while masking their true composition, casting doubt on the authenticity of the entire stockpile. Whispers even suggest that the U.S. might have leased or sold portions of its gold during the 2008 financial crisis to manipulate gold prices or generate emergency funds. All of this adds to the mystery surrounding America's gold. And there's one more element that intensifies this intrigue: the lack of a comprehensive, publicly disclosed audit of the U.S. gold reserves. Demands for such an audit have grown louder over the years, fueled by a lack of transparency and access that breeds suspicion and distrust. The last publicly acknowledged audit happened way back in 1953, during the Eisenhower administration. It was a limited inspection of just a small percentage of the gold bars. This audit, while reassuring at the time, falls short of today's standards of accountability. It does little to quell the anxiety swirling around the gold's existence. There was a highly publicized media tour of Fort Knox in 1974, often mistakenly referred to as an audit, but it was more of a PR stunt than a rigorous examination. Visitors, including members of Congress and the press, were treated to a carefully orchestrated glimpse of stacks of gold bars. They were even allowed to handle some for photo ops. This staged event aimed to ease public concerns, but it ultimately failed to provide solid proof of the gold's existence and integrity. A series of audits conducted between 1975 and 1981, overseen by the General Accounting Office and the U.S. Mint, involved a more systematic approach. They include opening vaults, counting bars, and testing random samples for purity. These audits, however, covered only a portion of the gold. Reports indicate that roughly 80% of the total U.S.-owned gold was verified by 1981. What's more concerning is that only a fraction of the gold bars were checked that are serial numbers. And here's the kicker: these audits have not continued since 1981. The U.S. Mint and the U.S. Treasury assure us that the gold is regularly inventoried and audited internally. But the details of these audits remain shrouded in secrecy, hidden from public scrutiny. This lack of transparency does little to inspire confidence. It only serves to fuel speculation and distrust. In 2017, that Treasury Secretary Stephen Mnuchin made a highly publicized visit to Fort Knox, accompanied by Senator Mitch McConnell and a select group of officials. It was the first time the sitting Treasury Secretary had stepped inside Fort Knox since 1948. After the visit, Mnuchin offered a simple but unconvincing reassurance: glad the gold is safe. The single visit by a handful of government insiders hardly qualifies as comprehensive and independent audit. Enduring mystery surrounding the U.S. gold reserves has reemerged in recent years, fueled in part by trade tensions and reports of massive gold shipments from London to New York. Some interpret these movements as a sign that U.S. gold holdings are being depleted, but the reality is more nuanced. These large-scale gold transfers are mainly orchestrated by major banks like J.P. Morgan and HSBC. They are driven by a sophisticated financial strategy known as arbitrage. Think of it like this: imagine buying apples in one town where they're cheap and selling them in another town where they fetch a higher price. That's essentially what these banks are doing with gold. They exploit price differences between gold markets in different locations. With gold currently priced higher in New York than in London, banks are capitalizing on this discrepancy by physically moving gold across the Atlantic. These banks act as market makers in the gold trade, playing a vital role in facilitating the global movement of gold and providing liquidity to buyers and sellers. A key aspect of their business model is gold leasing. They lend physical gold to other banks, investors, and institutions in exchange for interest payments. To manage their risk, these banks hedge their gold leasing activities by selling gold futures contracts in New York. It's like making a bet that the gold price will remain stable, protecting them from potential losses. However, unforeseen geopolitical tensions and uncertainties, particularly those arising from trade disputes, have disrupted this delicate balance. The price of gold in New York has climbed more sharply than in London, putting the banks' short positions, their bets on stable gold prices, at risk. To mitigate potential losses, they resorted to physically moving gold from London, where it's cheaper, to New York, where they can sell it at a higher price to cover their short positions and potentially profit from the price difference. While this arbitrage activity provides a plausible explanation for the recent gold movements, it doesn't address the core issue of transparency surrounding the U.S. gold reserves. Even tech mogul Elon Musk has weighed in on the debate, suggesting a live stream of the Fort Knox vaults to alleviate public skepticism. Such a move, while logistically challenging, would undoubtedly capture global attention and potentially provide some reassurance. The government's persistent refusal to conduct a full, transparent, and independently verified audit of its gold reserves only intensifies suspicions. While officials cite security concerns and the cost of such an audit as prohibitive, many remain unconvinced. They argue that the benefits of a comprehensive audit in terms of bolstering public trust and global confidence in the U.S. dollar outweigh the perceived risks. The potential consequences of a revelation that the U.S. gold reserves are not what they seem are staggering. Such discovery could trigger a global financial panic, undermining the credibility of the dollar and potentially leading to hyperinflation and a flight to alternative currencies backed by tangible assets like gold. This scenario, while hypothetical, underscores the importance of transparency and accountability in managing national assets of such magnitude. Despite the whirlwind of speculation and conspiracy theories, concrete evidence of wrongdoing remains elusive. All available information points towards the gold likely being held securely in U.S. vaults. However, the lack of transparency and the government's resistance to a comprehensive audit create a brief breeding ground for distrust and uncertainty, casting a long shadow over one of the nation's most valuable and enigmatic assets. The question lingers. If the government has nothing to hide, why not silence the rumors and suspicions once and for all with a full independent audit? The answer might lie in a delicate balance of power and perception that underpins the global financial system. A full audit, while seemingly straightforward, could unleash a torrent of unintended consequences. Imagine the fallout if even minor discrepancies were uncovered. The revelation, no matter how insignificant, could erode confidence in the US dollar, the world's reserve currency, sending shockwaves through global markets. Nations and investors might lose faith in the dollar's stability, triggering a rush to divest from dollar-denominated assets. Such scenario could lead to a steep decline in the dollar's value, fueling inflation in the US and destabilizing the global economy. The mere possibility of such an outcome likely enough to deter the government from pursuing a full audit. The risk of unintended consequences, however improbable, could outweigh the potential benefits of transparency, particularly in an increasingly interconnected and volatile global financial landscape. Furthermore, a full audit might inadvertently expose sensitive information about the management and movement of U.S. gold reserves, potentially compromising national security or revealing vulnerabilities in the financial system. For instance, the audit might disclose the extent to which the U.S. has engaged in gold swaps or loans with other nations' arrangements that could be deemed strategically sensitive. Such revelations could strain diplomatic relations or provide adversaries with valuable insights into U.S. financial maneuvers. Moreover, a detailed audit might expose weaknesses in the security protocols surrounding the gold reserves, potentially inviting unwanted attention from those seeking to exploit such vulnerabilities. The government may be reluctant to subject these critical assets to the level of scrutiny required for a full audit, fearing that such transparency could inadvertently compromise national security. The reluctance to conduct a full audit might also stem from a deep-seated desire to preserve the mystique surrounding the U.S. gold reserves. This aura of mystery, carefully cultivated over decades, has contributed to the perception of the U.S. as a financial superpower, a nation whose wealth and stability are underpinned by a vast and inviolable treasure trove of gold. This perception, however flawed, plays a crucial role in maintaining confidence in the U.S. dollar and the stability of the global financial system. A full audit, by dispelling this aura of mystery, could inadvertently weaken the dollar's standing and diminish the U.S.'s perceived financial strength, even if the audit confirmed the integrity of the gold holdings. The government may be hesitant to tamper with this carefully constructed narrative, fearing that increased transparency could inadvertently undermine the very foundations of the global financial order. The lack of a full audit also reflects a broader trend of declining trust in institutions, a phenomenon that has permeated many aspects of modern society. In an era of fake news, misinformation, and widespread skepticism towards authority, the absence of concrete evidence regarding the U.S. gold reserves only fuels conspiracy theories and deepens public distrust. This erosion of trust poses a significant challenge to the government's ability to effectively manage and communicate about critical national assets. Even if a full audit were conducted and the results were made public, it's uncertain whether such transparency would be sufficient to allay the deeply ingrained skepticism that has taken root in certain segments of society. The government faces a difficult dilemma: how to balance the need for transparency and accountability with the potential risks associated with dispelling the mystique surrounding the U.S. gold reserves and navigating a climate of heightened distrust. The enduring mystery of the U.S. gold reserves serves as a potent reminder of the complexities of managing national assets in an interconnected and increasingly volatile world. While the government maintains that the gold is safe, it accounted for the absence of concrete evidence and the refusal to conduct a full independent audit, leave room for doubt, fueling speculation and conspiracy theories. The reluctance to embrace full transparency might stem from legitimate concerns about national security, the potential for unintended economic consequences, or desire to preserve the aura of mystique that bolsters the dollar's global standing. However, the longer the government resists, calls for a comprehensive audit, the more it risks further eroding public trust and exacerbating anxieties about the true state of America's golden treasure. The future of the U.S. gold reserves remains shrouded in uncertainty. Will the government eventually yield to pressure and conduct a full audit, potentially unleashing a cascade of unintended consequences? Or will it continue to rely on assurances of security and internal audits, perpetuating an environment of suspicion and distrust? The answer likely lies in a delicate balancing act, weighing the benefits of transparency against the potential risks to national security, economic stability, and the perceived strength of the U.S. dollar. The recent flurry of activity in the gold market, with banks shuttling vast quantities of gold across continents, underscores the enduring significance of this ancient metal in modern finance. Despite the shift to a fiat currency system, gold continues to exert a powerful influence on global markets. It acts as a safe haven asset during times of turmoil and a key component of complex financial strategies. The movement of gold from London to New York, driven by arbitrage opportunities, highlights the interconnectedness of global financial markets and the intricate dance of supply and demand that shapes asset prices. The fact that banks are willing to bear the significant costs of physically transporting thousands of gold bars across the Atlantic speaks volumes about the potential profits to be made by exploiting even smaller small price discrepancies in this highly liquid and volatile market. This episode in the ongoing saga of gold raises thought-provoking questions about the future of this precious metal in an increasingly digital and interconnected world. Will gold retain its allure as a safe haven asset in the face of emerging digital currencies and decentralized finance? Will central banks continue to accumulate gold reserves, or will they gradually divest from this tangible asset in favor of more liquid and flexible financial instruments? Will technological advancements, such as blockchain technology, revolutionize the way gold is traded and tracked, enhancing transparency and security in the gold market? The answers to these questions remain elusive, but one thing is certain: gold, with its rich history, enduring mystique, and inherent value, is likely to continue playing a significant role in shaping the global financial landscape for years to come. Its journey, much like the quest for truth surrounding the U.S. gold reserves, is far from over. It's a journey marked by intrigue, speculation, and the enduring human fascination with this glittering symbol of wealth and power. So as we conclude our deep dive into the mysteries of America's gold, we invite you to contemplate the profound implications of this ongoing saga. What does the future hold for this precious metal in an era of rapid technological change and shifting geopolitical dynamics? Will transparency prevail, dispelling the shadows of doubt that linger over the U.S. gold reserves? Or will the allure of secrecy and the weight of tradition continue to shield these golden secrets from public scrutiny? These are questions that demand our attention, for the answers may well shape the destiny of nations, the stability of the global financial system, and our collective understanding of the intricate dance between wealth, power, and trust in the modern world. Don't forget to like and subscribe to the channel for more deep dives into fascinating and thought-provoking topics. Until next time, keep exploring, keep questioning, and never lose your thirst for knowledge.